Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, welcome back to the fourth video of ESOP chapter, Employee Stock Option Plan. This chapter of Group 2 Advanced Accounts we have started. Now so far in the previous videos we have seen the concept and the accounting treatment, the journal entries and important terms of ESOP, yes, in the first video, and then in the second and third video we have solved problem. In the second video we have seen the illustration 2 of the study material, and then in the video 3 we have seen the illustration 4 of the study material, right? So if you haven't watched these videos, then please make sure you watch these videos first and then come back to this video, right? So now in this fourth video of ESOP, what we are going to do, we are going to solve illustration 5 of the study material, right? So let's start. Now here we have the question. Let's go through it once and let's try to understand what is happening over here, in which order the events are happening. That's the most important part, right? So what we're going to do is we are going to put this question into a diagram to have a proper interpretation, right? So let's start. See here, P Limited granted option for 8,000 equity shares of nominal value 10 rupees on 1st October 2010 at 80 rupees when the market price was rupees 170. So till here we come to know that this company P Limited has offered options to its employees, and the total options offered are 8,000. Yes, the total ESOPs that are offered are 8,000. Now in some question what happens, they give you the number of employees and the options offered to each employee. If they do that, then you just have to multiply those two together, you will get total number of options offered, right? But here they have given you directly the whole figure. Yeah, granted option 8,000, right? Clear? Yes. And then they are saying the face value of those shares are rupees 10 and the price at which ESOP the options are offered is rupees 80. So this is our exercise price. This is our exercise price, the concessional price at which the ESOP are offered, and then they have given us the market price also 170. So what is the value of option? How do you calculate value of option? Value of option is not given over here. So you have to calculate the value of option with the intrinsic value method, right? So how do you do that? Simple. See here, market price 170, it's given. Exercise price, the price at which ESOP are offered. Yeah, just subtract those two together, you will get value of option, the discount that is being offered by the company to the employees to make the ESOP attractive. Otherwise, why would the employees will go for ESOP? They will not. So to motivate them and to to make the ESOPs attractive, what they do, they give huge discounts. Yeah, and the discounts in this chapter technically we call that as value of option. Yeah, you have to calculate the value of option if it is not given. If it is given directly, such as fair value of option, then that's the first priority, just take it directly. Yeah, now here till the first para we come to know 8,000 options have been offered and value of option is 90, exercise price is 80 and market price is 170. Then right, they are saying the vesting period is 4.5 years. Now what is the vesting period? This is the eligibility period. Mostly what will happen, the companies when they offer the ESOP will always be offered with the condition. There will be some condition, you know that, right? Condition means what? You have to be employed for a certain period. Now here the vesting period is 4.5 years. Now mostly what is this? This is the service condition. Yeah, they are telling to their employees to be eligible to purchase the shares in the future at low prices such as rupees 80, where our market price is 170. To be eligible to purchase the share, what you have to do? You have to satisfy our vesting condition, eligibility conditions. Only after 4.5 years, after being an employee for our company, then only you will be able to use these ESOPs which we are offering now. Yeah, which we are offering now at the grant date, but you will be able to use that only in the exercise period after satisfying the vesting condition, the vesting period, that is be the employee for 4.5 years. Yes, that's a vesting period. So vesting period is 4.5 years. Yeah, so see here the grant date is what? The grant date is 1st October 2010, right? So 1st October 2010, can you see that? 1st October 2010, that's the grant date at which the ESOPs are offered, and then they are saying the vesting period is 4.5 years. So just take that 4.5 years, 0.5 year. Yeah, because it's offered in the middle of the year, right? October. So till 31st March, okay, 0.5 year, half year has been passed, then 1 year, 2 year, 3 year, 4 year, 5 year. Sorry, not 5 year, 4.5 year. Yeah, 4 year. This is the 4th year actually. Yeah. So as you can see, 0.5 year has been passed, 1.5 year has been passed, 2.5 year has been passed, 3.5 year has been passed, and then finally the whole vesting period 4.5 year has been passed till 31st 3 2015, 31st March 2015, right? So this is the entire vesting period. Okay, and then what will happen? Then the exercise period will start, in the period where the employees will have to use their ESOPs, have to use their options to purchase the share prices at the rupees 80 low prices. Yeah, that's the ESOP. Yeah, that's the whole concept of ESOP. So vesting period is 4.5 years, and then they are saying 4,000 unvested options lapsed. Lapsed means what? It has expired on 1st December 2012. Now what is happening over here? Maybe some employees have left the company. If they leave the company, what will happen? They didn't satisfy the vesting period. Yeah, in somewhere in between they have left the company, so their options will become expired. It will not be any of use, right? So it will become expired. So what you have to do? You have to cancel those options, right? So see here, what will happen? In which year it has happened? 1st December 2012. So take a note of that properly. Yeah, you have to properly put it into a diagram so that you can understand which things are happening when, right? So here, see, this is the 31st March 2012. So here they are talking about 1st December, so 1/12/12, isn't it? So it will happen after the March, right? So what here somewhere, isn't it? 1st December 2012, 4,000 options have been lapsed. Is that clear? Yeah, see here, 31st March 2012, then only that has happened, right? It is 1st December 2012, so 4,000 options have been lapsed. Clear? Yes. So take a note of that. Then what they are saying, 3,000 options were exercised on 30th September 2015. That means these options have become eligible. Yeah, they have satisfied the condition, the employees have satisfied the condition, and those options have become eligible to be used by the employees and purchase the share prices, I mean the shares at low prices, right? So these were exercised on 30th September 2015. So that falls after the vesting period, somewhere in exercise period. Yeah, in exercise period what has happened? The employees have used their 3,000 options. Yeah, 3,000 options have been used on 30th September 2015. Yeah, and they have purchased the shares, right? Then they are saying, and 1,000 vested options lapsed at the end of the exercise period. What does this mean? It means that some employees, even after satisfying the condition, even after being the employee for 4.5 years, they haven't used their options. Yeah, and what happened? After the vesting period, a period will start that is called exercise period, which will be, prescribed by the company. In that certain exercise period only, the employees will have to use their options to buy the shares. If they don't do that, what will happen? The options will get lapsed. Yeah, they will be lapsed, they will get expired. Is that clear? So two type of lapse is there. One is in the vesting period, if the employees leave the company or they break the conditions, and the another lapse is that happens after the exercise period. So at the end of the exercise period, some employees didn't use their options, so those options got lapsed, expired. You understand that, right? So simple. So till here what we come to know: market price 170, exercise price 80, value of option 90, number of ESOPs is 8,000 options, vesting period is of 4.5 years, right? And the grant date is in the middle of the year, so that's why we have taken here half, and then 1 year, 2 year, 3 year, 4 year. So in total it is 4.5 years. Yes. And then in the second year, what has happened? In the second year, 4,000 options have been lapsed, right? So you have to properly take that into account. Yes. So now let's solve the problem. You understand these things, right? Okay, then let's solve the problem. Let's pass the journal entries. Now let's solve the problem. See here, the first thing that we have to do is we have to do the calculation of employee compensation expense. What is employee compensation expense? It is the expense that is company is incurring because of ESOP. Yeah, what is happening in ESOP? In ESOP, the company is offering the options to the employees at very low prices. So if it is offering at low prices at rupees 80, that means it is giving discount. 90 rupees discount is being offered. So this 90 rupees discount is what? It is an expense. It's a discount, right? It's a loss to the company. So it has to go to profit and loss. Now I'm not talking about only 90 rupees. 90 rupees, that's a discount into the total options, 8,000. Yeah, so in total it is 7,20,000. Yeah, 7,20,000 expense is being incurred by the company because of this ESOP transaction. Yes. And how do we take it to profit and loss? Can we take it entirely into the first year profit and loss? It is expense, right? It has to go to profit and loss. So can we take it into the first year? No, we can't. We can't do that. What we have to do here, we are incurring this 7,20,000 expense because of ESOP, and the benefit of ESOP we are getting, the company is getting over the entire vesting period. The employees are working for the entire vesting period. Yeah, so we are getting the benefit, the service from the employees for the entire 4.5 years. So similarly, this expense which is related to ESOP it also has to be spread over the entire vesting period. You cannot take it entirely, this 7,20,000 to first year profit and loss. No, you can't do that. You have to take it slowly into what, these 4.5 years. Yeah, in this entire period you have to spread it. Yeah, in all the years of these 4.5 years you have to take it, right? That's how you have to take it into profit and loss. So for that we have a bit calculation that is called calculation of employee compensation expense, and every year how much are we going to take to profit and loss, that's what we have to calculate. Is that clear? So there's a bit formula over here. We are going to go through the formula now, but let me tell you, at the grant date we will not pass any journal entry. Okay, at the end of every year we are going to pass the journal entry, how much expense to be taken to profit and loss at 31st March, 31st March, 31st March, 31st March, and then what do we do with the expenses? We transfer the expenses to the profit and loss, isn't it? So these two entries you have to pass at the end of every year. Employee compensation expense account debit, you are recognizing the expense. Yeah, when you pay the salary, what do? Salary account debit to cash. But if you don't pay the salary is outstanding, what do? Salary account debit, you are recognizing the expense, you have to, but then are you paying anything? As I said, salary is not paid, it's outstanding. So what are you going to do? You are going to recognize a liability. You recognize a liability to salary outstanding account. Similarly here, are you giving anything to employees at the end of first year? No, you are not. They have to be eligible, then only you will give shares in future. They will be able to purchase the shares in future. Yes, so at the end of every year, here, what are you doing? You are not gonna give them anything. Just recognize the employee compensation expense and transfer it to profit and loss. That's what you're going to do. So if you're not giving them anything and you're going to give them in future, obligation, kuch doge in future, right? You're going to give them something in future. So you have to recognize a liability to ESOP outstanding account. To ESOP outstanding or ESOP outstanding, okay? ESO outstanding or ESOP outstanding. Yeah, same things, right? And then what do? At the same date, you are going to transfer the employee compensation expense to profit and loss. That's the accounting treatment we have regarding ESOP, isn't it? Yeah. So these two entries you have to pass at the end of the at the end of every year till the vesting period finishes. Yeah, till the options are exercised. Yes. Yeah, so that's what we do. So now let's do the calculation here, the calculation of employee compensation expense. Yeah, see here the calculation is very simple. The formula we have, what is this formula? Number of ESOP expected to avail. कितने ESOP exercise करेंगे employees in future. What we have to do here, at the end of every year we have to estimate, the company will estimate कितने employees, कितने options, not employees, कितने options, how many options will be exercised in future. We will not have details regarding this. Yeah, at the end of this 31st March 2011 we will not have details regarding this. We will estimate over here how many options will be exercised in future. That's what you have to take. Number of options, number of ESOP expected to avail into value of option. What is value of option? The discount that is being offered 90 and it will never change. Okay, value of option will always be constant. It will always be constant. Remember that. It will always be constant. Even if fair value of option is given, it will always be constant. And the market price also always at grant date. You know that, right? If 3, 4, 5 market prices are given, the market price of 2012, 2014, just ignore that. We take the market price of only at the grant date, GD. Is that clear? So market price in the question it is said, right? See here, where is it? On 1st October 2010 at rupees 80 when the market price was 170. So this, the market price is of 1st October 2010. So this is the market price that is important. Okay, that's what you have to consider, right? So see here what we're going to do, number of ESOP expected to avail, कितने option exercise होंगे in future. Yeah, we will estimate it, right? And then value of option rupees 90 which will never change, always constant. ये change हो सकता है, this can change. Yeah, because if the estimate changes, yeah, देखो इधर ये 2013 में क्या हो रहा है, change हो रहा है क्या नहीं? नंबर ऑफ ESOPs एक्सपेक्टेड टू अवेल चेंज हो रहा है. 8000 था, 8000 था, इधर 4000 हो रहा है. क्यों 4000 हो रहा है? वाई इट इज 4000 ओवर देयर? बिकॉज 4000 ऑप्शंस हैव बीन लैप्स इन द प्रीवियस ईयर. सो इफ इट हैज बीन लैप्स देन हियर वी कैन expect safely that in the future only 4000 options will be exercised, isn't it? अगर 4000 इधर एक्सपायर हो गए तो क्या है, बचे हैं 4000 हम सोच रहे हैं कि एक्सरसाइज हो जाएंगे, isn't it? Yes. So let's see the calculation. See, the calculation is very simple. Number of ESOP expected to avail into value of option into lapsed vesting period divided by total vesting period. कितना vesting period गुजर गया और total कितना vesting period है. How much vesting period has been lapsed has been gone by, has been passed, and what is the total vesting period. That fraction you have to take. It's very simple. We have been doing this since the 2 problems now. And then you have to subtract the expense that is already recorded in previous years. मतलब देखो ये कैलकुलेशन में तुम्हें पता चलेगा. थर्ड ईयर का एग्जांपल ले लो. 2,40,000. हाउ डिड आई टेक हियर 2,40,000? 80 plus 160. 80 plus 160 is 240. Yes. So whatever that has been recorded in the previous year, you have to subtract that. Yeah. मतलब if you are calculating the employee compensation expense of, let's say here 2013. Okay. 31st March 2013. What you're going to do? You are going to deduct whatever that was recorded in the previous year on 2011 and 2012. Is that clear? Add it and subtract like that. Okay. So let's see the calculation. Simple. At 31st March 2011, what is happening? 8,000 options we are thinking will be exercised, because total options are 8,000, and we can safely assume nothing is being said in the question, right? So we can safely assume all the options 8,000 will be exercised in future. So 8,000 into 90, value of option will never change, it will stay the same, into what? 0.5 divided by 4.5. See here, this is happening on 31st/3/2011, at the end of this year. Yeah, we issued the options, we offered the options at 1st October 2010. So this year is ending on 31st March 2011. So only how much? Half year has been passed, right? Only 6 months have been passed. Yeah. So that's why we have to take 0.5 divided by the total vesting period. आधा साल गुजर गया, 4.5 साल बाकी है. Half year has been passed, whole is remaining, right? Not remaining, I mean the total vesting period is 4.5 years. Yes. So let's put this into calculator. It's very simple. Let's not waste any time. See here, 8,000, right, into 90 into 0.5 divided by 4.5, that is equal to 80,000. Now we can't subtract anything. Why? Because nothing has been recorded previously, right? इसके पहले कुछ रिकॉर्ड हुआ है? कुछ भी प्रॉफिट एंड लॉस में रिकॉर्ड नहीं हुआ है. If some expense has been recorded in the profit and loss in the previous year, then only we have to subtract. So nothing has been recorded, so minus 0, it's equal to 80,000 only. Is that clear? Then 31st March 2012, still we can safely assume that all the options will be exercised in future, क्योंकि कुछ mention नहीं है ना, otherwise nothing is mentioned otherwise. If something had been mentioned in the question, then we would have changed our estimate, but nothing is mentioned. We can safely say that all the 8,000 options will be exercised in future. So 8,000 into 90, the value of option, into the vesting period. Till 31st March 2012, how much year has been passed? 1.5 year has been passed, and the total vesting period is 4.5 years. So see here, 8,000, number of ESOP expected to avail, into the value of option 90, which will never change, into 1.5 year has been passed, divided by the total vesting period 4.5 years, right? So that's equal to 2,40,000. But then can we just directly take 2,40,000 to PNL? No, we have to subtract whatever that was previously recorded in the PNL, that is 80,000 in the first year. So minus 80,000, that's equal to 1,60,000. So 1,60,000 you are going to recognize into the second year PNL. Is that clear? Then we come to 31st March 2013. Now here what has happened? See here, the question says, let's get the question. The question says, see here, 4,000 unvested options, 4,000 ineligible options have been lapsed on 1st December 2012. Now where does that fall? 1st December 2012, it falls in here, right, in the second year. We have already seen that while reading the question. So 4,000 options has been lapsed. So at the end of this year, we can safely assume that 4,000 options only will be exercised in future. सिंपल है ना, 4,000 गए तो 4,000 ही बचे हैं, तो सोच सकते हैं, एस्टिमेट लगा सकते हैं that 4,000 will be exercised in future. So that's what we have to take, 4,000. In which year? In this year. Okay, इधर नहीं कर सकते थे, क्यों? Because this happened in future, we didn't know that, right? In that second year we couldn't do that. We couldn't estimate that only 4,000 options will be exercised, because we don't have the information of future. Yeah, we are not God, right? Yes, you got that. So 4,000 into the value of option into 2.5 year has been passed, divided by the total vesting period 4.5. Yeah, till here 2.5 year has been passed, the total vesting period is 4.5. So that's a fraction. So let's put that into calculator. 4,000 into 90 into 2.5 divided by 4.5, the total vesting period, that's equal to 2 lakh minus whatever that is previously been recorded in the PNL. The previously what is recorded? 80,000 and 160. If you add 80 plus 160, how much is it? 80 plus 160 is 2,40,000. Yeah, 80 plus 60 is 240, so 2,40,000, right? So you have to subtract 2,40,000. 2,40,000 minus that's equal to minus 40,000. So here we are getting a negative figure. Whenever we get a negative figure, what we have to do? We have to reverse the liability. The liability which we recognize and the expense which we record at the end of every year, yeah, we have recorded more till here. So what we have to do? We have to reverse the liability. That ESOP outstanding, we have to reverse it. Okay, so entry would be like this. See here, ESOP outstanding account debit. You will reverse the liability. How will you reverse the liability? Just debit it. Liability has credit balance. To reverse it, you are going to debit that and you are going to transfer that to general reserve. We'll see that later. Okay. The entries are very simple, debits and credits. We have been doing that, right? But this is very important, the calculation. Yeah. So see, then the fourth year, what is happening? 31st 3 2014, 31st 2014. Again, we can safely assume that 4,000 options will be exercised because there is no mention of otherwise, right? So 4,000 options will be exercised. So 4,000 into value of option, which will never change, into 3.5 year has been passed. 3.5 year has been passed. The total is 4.5. So let's put that into calculator. 4,000 into 90 into 3.5. Sorry. 4,000 into 90 into 3.5 divided by 4.5, the total vesting period, that's equal to 2,80,000. And previously what we have recorded, now understand this properly. In the first year we recorded 80, in the second year we recorded 1,60,000, or you can directly see this amount. Yeah, previously जो भी रिकॉर्ड हुआ था यहाँ लिए है ना पिछले साल में, so directly see we have recorded in the previously 2,40,000, but then you know, in this year, in the third year, what we have recorded, we have reversed 40. Yes, if we have reversed 40, then in the P&L, how much is there? Only 2 lakh is there, isn't it? See here, let me just do that in calculator. Remember this amount, okay? 2,80,000. I mean, this calculation we have got 2,80,000. Remember that. All right. So see, in the first year we recorded 80, right? In the first year recorded 80. In the second year we recorded, first year we recorded 80. In the second year we recorded 160. So in 2 years we recorded 240, and then we reversed 40 minus 40. Yeah, we reversed 40 minus 40. So till now we have recorded the expense of 2 lakh. Yes, so that 2 lakh I have taken over here. This 2 lakh we have to subtract. From here we got 2,80,000. 2 lakh we have to subtract. So see here, 280 minus 200, 2 lakh, that is equal to 80,000. Is that clear? Yes, so 80,000 will be recognized employee compensation expense to profit and loss in the year of 2014. And then we have reached at the end, see here, 31st 3 2015, just before the exercise period. Yeah, now here also we can safely assume 4,000 options will be exercised in future. So 4,000 into value of option into 4.5 by 4.5. Now this will get cancelled out, but I'm just doing it because of the format, right? So see here, 4,000 into 90 into 4.5, the entire vesting period has been passed, yeah, till 2015, and the total vesting period is divided by 4.5, so that's equal to 3,60,000. And then previously what we have recorded, 80 plus 160 plus 80, that is equal to 2,80,000. All right, so that's what we have to subtract. Yeah, and see here, let's do this calculation so that you don't get confused. See here, this was 3,60,000. Okay, so see here, 80 in the first year plus 160 in the second year minus 40, yeah, we reversed, right? And then plus 80 in the fourth year, so that's equal to 280. Yeah, that's how I got 280 over here. Or what you can do, simply 2 lakh was recorded, yeah, in the last second year, and then what are you going to do? You are going to add this together, 2 lakh plus 80, 2,80,000. Like that also you can do. There are two ways. Yeah, this is the shortcut, 2 lakh plus 80, 2,80,000. Like that you can also do, right? So let's do this again. 4,000 into 90 into 4.5 divided by 4.5, that's equal to 3,60,000 minus 2,80,000, that's equal to 80,000. So 80,000 will be recorded in the last year. Okay, clear? You clear with the employee compensation expense? Easy, right? Yes. Now let's go to the journal entries. Let's see how to pass the journal entries. Now the journal entries are very simple, debits and credit, that's all right. So see here, at the end of the first year, 31st 3 2011, yeah, now at the grant date we don't pass any journal entry, right? I have already told you. So here what are we going to do? Recognize the expense, transfer it to profit and loss. Recognize the expense, transfer it to profit and loss. That's what we have to do. So I have taken shortcuts over here, okay, short forms. Employee compensation expense account debit, ECE account debit, 80,000. How did I get this amount? 80,000. Yeah, that's why we have to be very careful with the calculation. Yeah, and this diagram also, if you mess up the diagram, if you don't understand properly kitne options exercise hone wale in future, then in the calculation you will take this wrong. I've told you this is variable, this can change depending upon the estimates. So that's why you have to be, you have to understand properly the diagram, the question, and put it into a diagram, and then the calculation also to be very perfect. And then the journal entries is very simple, easy, right? So employee compensation expense account debit, recognize the expense, debit the expense, and then recognize a liability because you are not paying anything. You have an obligation to give shares in future, so recognize a liability. Actually, this is not liability, okay? This is an equity actually. But here, to understand the journal entries, to do the calculation and everything, we are thinking like it's a liability. Actually, this will be shown at the end of the balance sheet date on the reserves and surplus under shareholders funds. Okay, keep that in mind. Okay, so that you don't make a mistake. Yeah, if it's asked in theory. Yeah, right. So EC account debit 80,000 to ESOP outstanding account 80,000, and then what do you do at the end of every year? You transfer the nominal accounts to profit and loss. I have told you, right? Even in salary, if you pay the salary or not, you have to transfer the salary account to profit and loss. Similarly here, employee compensation expense is what? A nominal account. Yeah, so that has to go to profit and loss. So debit will be equal to credit and will get cancelled out, and it will go to profit and loss account. Right, so profit and loss account debit 80,000 to ECE account 80,000, simple. And then the second year, 31st March 2012, again the same thing you have to do. Just look at the calculation and pass the same entry. Employee compensation account debit 1,60,000. See here, 1,60,000. So take that to ESOP outstanding 1,60,000, recognize the liability, and then transfer it to profit and loss. What? Not the liability, the expense. Employee compensation expense account will be transferred to profit and loss. Profit and loss account debit on the same date, 31st March 2012, 31st March 2012. Yeah, all these things are happening at the end of the year. Okay, don't think that we are recognizing the expense in advance and then we are transferring at the end of the profit and loss. No, that's not happening. We are doing everything at the end of the years. Is that clear? So profit and loss account debit 1,60,000 to employee compensation expense account credit 1,60,000. Simple. Then third year, 31st March 2013, same thing. No. Here what has happened? 31st March 2013, 40,000 negative we have got in the calculation. So if we get calculation in negative, what do? We reverse the liability. The liability which we were recognizing here, that thing we have to reverse it. How do you reverse the liability? To reverse the liability, what are you going to do? ESOP outstanding account debit, you're going to debit that because liabilities have credit balance. You're going to debit that and transfer it to the free reserve called a general reserve. Before, where it was in the balance sheet, it used to be under the reserves and surplus, right? But it was not a free reserve. Now what are you doing? Just opening that reserve up by 40,000 and transferring the balance to general reserve. सिर्फ प्लेट नंबर चेंज कर रहे हो. पहले क्या था? ESOP outstanding in reserves and surplus. अब क्या कर रहे हो? General reserve under reserves and surplus. Simple है ना? Reserves have credit balance. To increase them, what you're going to do? You are going to credit them, right? So to general reserve account, credit 40,000. Simple. So एक ही entry होगी. Only one entry will be there in the 31st March 2013 because here you're just reversing the liability. You are not recognizing the expense. Yeah. So you can't transfer anything to profit and loss. So only one entry will be there in 31st March 2013, and then we come to the last year, not the last year, 31st March 2014. Yeah. 2014 year, again the same thing that you did over here. Employee compensation expense account debit 80,000 to ESOP outstanding account 80,000. Yeah, how 80,000? See here, calculation. Then we got 2015 here, yeah, transfer to profit and loss. And then in 2015 again the same thing, employee compensation expense account debit to ESOP outstanding 80,000. And then what do? Transfer to profit and loss. 31st March 2015, profit and loss account debit 80,000. Yeah, debit the profit and loss account and transfer the employee compensation expense to profit and loss. Yeah, now here what is happening? Employee compensation expense gets debited first. Yeah, you recognize the expense first and then you cancel the expense. Yeah, you transfer it to profit and loss, right? So this debit, this equal to credit, it get cancelled out. You know that, right? Yeah. So what we did so far, at the end of every years we recognize the expense and liability and we transfer the expense to profit and loss. Here 31st March 2011, 2012, 2013, 2014, 2015. We did this till the vesting period. Now the exercise period comes. Exercise period comes, right? So now in exercise period, what are we going to do? In exercise period, what will happen? The employees, as the question says, employees have exercised their right. On 30th September 2015, what they have done? 3,000 options were exercised. 3,000 options were used by the employees and they purchased the shares at concessional price at the exercise price of rupees 80. So that's the entry we have to pass on 30th September 2015. So see here, how are we going to do that? It's very simple. Bank account debit ESOP outstanding account debit. So see what's happening over here. We are not giving the shares for free. No, we are giving the shares at very low prices. Yeah. So the liability which we were recognizing, yeah, ESOP outstanding, that liability has to be cancelled out. Okay. So whatever you recognized over here, जो balance sheet में accumulate हो रहा था under reserves and surplus, है क्या नहीं, इधर सब जगह accumulate हो रहा था. So that liability you have to cancel out till the extent of what? Till the extent of the shares that have been purchased, the options that have been exercised. In this entry I'm talking about. Okay, so bank account debit, the money has come in because the employees have purchased the shares at low prices. So somewhat amount they have paid, right? Rupees 80. So how many options have been exercised? 3000 options have been exercised. Let me tell you this again. I have told this in the previous video. See here, exercising entry, cash or bank account debit, exercise price. Hamesha, always cash and bank account will play its game on exercise price. Yeah, because that's the money we are getting, right? Exercise price. And then ESOP outstanding account always plays its game on value of option. ये हमेशा खेलेगा value of option पे. क्यों value of option पे? Because what is ESOP outstanding account? First it was expense, right? We recognize a liability with that, isn't it? Employee compensation expense होता है, वो किस पे होता है? Value of option पे होता है ना, उसी से हम liability recognize करते हैं, right? So that's what, right? So ESOP outstanding account will always play its game on value of option, and then in equity share capital account what will go? Face value. Then whatever balancing figure or over the face value amount will be there, that will go to securities premium account. Is that clear? That's the entry of exercising the option. So see the entry here in this question. Bank account debit, we have received the money. How much money do we have received? The options that have been exercised are 3000, isn't it? 3000 options have been exercised. So into what? Exercise price. What was the exercise price? The low price which we offered, rupees 80, into rupees 80, that's equal to 2,40,000. So 2,40,000 will come in bank account, and then in ESOP outstanding what? 3000 options have been exercised, but the discount which we offered, that you have to cancel. So 3000 options have been exercised. The discount was, the value of option is 90, so into 90, that's equal to 2,70,000. That's the amount you have to take. And then what are we giving them? In the salary entries, if you talk about salary entries, in salaries what we do? We cancel the liability and we give them the cash. Yeah, when the salary was outstanding, you pass the outstanding entry. Yes, and then when you paid the salary later, what do? You cancel the liability, salary outstanding account debit, and you pay the cash, so cash account credit. But here, are you paying anything? You are not paying anything, you are giving them the cash. So the company's share capital will increase. You are giving them the shares, right? So 2 equity share capital account, 3000 into 10. All right. So 3000 shares, the face value was rupees 10, isn't it? In the question it is said the nominal value, the face value is rupees 10. Yeah. If it is not given, then you have to assume, okay? Right. So that's equal to 30,000. So 30,000 will go to equity share capital account, and then whatever extra is there, that will go to securities premium. Now what was the value of the share? Not the value of option, I'm talking about value of share, market price, value of share. Value of share is 170. So if 170 is the value of the share, the nominal value is 10, then whatever that is extra, 160, yeah, value of share is 170 minus the nominal value, the face value, the remaining is what? Securities premium. Any amount over the face value will go to securities premium, that's the 160. So 160 into the option exercise into 3000, that's equal to what? 4,80,000. So securities premium will go 3 lakh into 160, 4,80,000. Or what you can do is just take the balancing figure, 2,40,000 plus 2,70,000, that is equal to something, minus 30, you will get 4,80,000. Like that also you can do. Okay, but it's better to show the calculation like this. Okay, it looks good, right? Then what happened? Then at the end, you know, 100,000 vested option lapsed at the end of the exercise period. Yeah, some employees, what they did, they didn't exercise their right. Yeah, they didn't, you know, they became eligible with their options, but they didn't use their options to purchase the shares at low prices. And a time passed, and then what happens? If the exercise period ends, the option, the vested option, the eligible options will become lapsed. They will be expired, and the employees will not be able to use them anymore. There will be a time limit set by the company. Okay, that's called exercise period, within which the employees will have to exercise their options. right? So 1000 vested options lapsed at the end of the exercise period. Now we don't know what's the end of the exercise period, because here they have not mentioned the, you know, the time of the exercise period, whether it is 6 months, 1 year, 2 months, 3 months. So we can't take the date over here for this transaction. Yeah, you can mention a note below if you want. Yeah, so ESOP outstanding account, what's the entry for that? Whenever the options get lapsed, what do? Same entry, ESOP outstanding account debit. Yeah, the entry which you passed over here. Yeah, whenever you get a negative figure, you have to pass this entry, or the options lapse here at the end, you also have to pass this entry. Okay, ESOP outstanding account debit to general reserve account. Yeah, you are transferring this locked reserve to general reserve. Yeah, free reserve. So 90,000, 90,000. Now how did I get this amount 90,000? See here, 1000 options have been lapsed, and I've always told you ESOP outstanding, this account always plays its game on value of option. It always plays its game on value of option. ESOP outstanding account always value of option. So that's why into value of option into 90, that's equal to 90,000. Is it clear? Easy. So this is what we have to do. It's a very simple question actually. The only thing that was confusing is here this 4.5 years, 2.5 years. So you know, students get confused in that. Yeah, so 0.5 divided by 4.5, 1.5 divided by 4.5, 2.5 divided by 4.5, like that you have to take here. Yeah, but sometime when the performance condition comes, what will happen? That's illustration number 6. Okay, the vesting periods will change. Yeah, so you have to understand the illustration 6 properly. In there's performance condition and the vesting period changes. Okay, it will not be like this 0.5 divided by 4.5, 1 divided by 4.5. No, it's different. Every time it's different. Yeah, so we'll see that later. So now you understood this problem, right? Easy, right? The journal entries are nothing. You just have to understand the calculation and just know you don't have to make this mistake. Okay, you have to understand this properly. Okay, don't mess up, right? Cash out bank always on exercise price, ESOP outstanding always on value of option, like that you have to understand. And some students, what they do is, see here, during the vesting period, if the options get lapsed, you don't have to pass any additional entry. No, you pass additional lapse entry after the vesting period, somewhere in the, after the exercise period. But if the options get lapsed over here, then what will happen? Automatically it will get adjusted in the calculation. Okay, see here, we got minus 40,000, so we pass the entry for that. You don't have to pass any additional entry because 4,000 options have been lapsed, so I will pass any additional entry. No, don't do that. Okay, it will be automatically adjusted in the calculation itself, right? Okay then, okay, all right, see you, bye.